Hey traders, Ron here, Traders Academy. And as you know, it's our goal to coach and train traders of all levels. Typically we do that through our podcasts, our blogs, our meetups, and our webinars. But a few weeks ago we had the idea to put out through social media a question to all of you asking, what is your biggest challenge or obstacle that's preventing you from creating consistent trading results? And the response was overwhelming. So what we decided to do was take those responses and create a series of mini courses, each one answering a specific response. So we hope you enjoy these, hope you find them informative, and thanks for watching. Welcome to mini course 5, Futures, How to Trade Futures in Large and Small Accounts, and this will be part 4 of our 4-part series. So the question was, I really feel more comfortable trading commodities and stocks, but I've always been told that they are still very high risk. I only have a small account, so I've never really gotten involved. How should I begin if I want to trade futures, and is there a way I can trade without having the excessive risk associated with futures? Any help would be great. So once again, I first want to say that the futures market is by far my favorite market to trade. But at the same time, I'm a firm believer that to be fully and properly diversified, you need to maintain positions in all 3 major markets. That would be equities, forex, and futures. And by doing this, you'll be much better placed to offset the wild market swings in the equities market. So just don't give up on the other 2, as you're going to need them just as well. But now to be more specific and answer your question. So the first part of your question was asking how you should begin if you want to start trading futures. And we covered that in parts 1 and 2. So now let's work on the second part, which was, is there a way I can trade without having the excessive risk associated with futures? So we first started in parts 1 and 2 with the standard method practiced by most futures traders, and that is either buying or selling, which means going short, a futures contract. For you, the problem with this method is that it carries the greatest risk because of 2 factors, the first being the associated large capital outlay required to cover the margin required to either buy or sell a futures contract, and then there's the second, which is the fact of the high level of leverage involved with all futures contracts. This means that any small move in the price of the futures contract will result in a relatively large move in your account. And if the price moves against you, that amount could be staggering. And in part 3, we describe several trading strategies that will allow you to still trade futures, but with far less risk and requiring less capital. So now let's go into our trading platform, Thinkorswim, and look at several actual setups. Okay, we're in our Thinkorswim platform. So as I outlined, the first step that you would want to do is start looking at some charts and finding either some futures commodities that were trending up, trending down, or trending sideways, all within an orderly fashion. So let's go to the Charts tab, and let's look at a couple charts here. Some well-known ones, crude oil. Whoops. And I would say right now crude oil is trending up. So let's do a couple examples there. Let's go to the Trade tab. So remember I said if a commodity was trading up, you would want to sell a naked put. But first off, let's look at what it would cost so we have something to compare against just the outright purchase of a contract. So we have our active contract here. It says active right there. 20 days to go. So let's see what it would take to buy one of those contracts. So it would cost us $3.76 to buy one. But you'd have to tie up $4,125 to put that trade on. So a lot of money you're tying up for no guarantee of anything at this point. So that's what we're comparing it to, is to tying up $4,125. Remember, we're talking about doing all this in small accounts. So now let's go down and find an option that's about a month out. So that would be this one here, January 20, 23 days. And let's look at that, and let's say we want to sell a put, like I said. So we'd want a 10 delta. And actually, they aren't even trading that far out. So, wow. So, at least we're not getting a price on it anyway. Maybe we could. Okay, we still get it. So now by doing that, it's probably because it's a holiday and numbers just aren't populating. We would have a credit of $346, and we would tie up $1,478. So let's do the math on that. If you brought in 346.24 divided by the amount you're tying up, 1478, that would give you a 23% return for the 23 days we have until expiration. So not bad there. And that's how you would play something that is trending up. So now let's see if we can find something else. Natural gas, this one's trending down. So we can look at that example also. Let's go over to our trade tab. First off, let's compare that to the actual contract. We'll do the active one, 28 days out. Then we want to sell a single. If we look at that, the 376 and 26.95. So still we've cut that number down quite a bit from the direct selling of a contract. But 26.95 is still a lot of money for a small account. So let's look at some alternatives to that. So let's go out here. Oh, let's do 27. Let's do this one. And in this case, we want to sell a call because it's trending down. That one. So this would give us a credit of $106.24. We'd have to tie up $1,216, so in the neighborhood of half what we had before, a little less. So let's see what our return for that would be. And that would be 6.24, 1216. That's only 8%, so not as good, but 8% still for 27 days under most investment conditions would still be considered pretty good, I think. So now let's find something that's trending sideways, and I happen to know what that is. Gold trending nicely sideways. You see I have channels here where we've been trading. We bounce off of resistance, work our way down to support, work our way back up to resistance. So this is very typical textbook channel trading, sideways pattern trading. It's staying in the channel, working off support and resistance. So in this case, we have two different trades we could do. Remember I said if it's trading sideways, you could sell a strangle. Again, let's look at 10 deltas or less. So we would sell that put, and we would sell this call. That's one contract. We would collect 420. So there we would collect $412.58, tying up $29.51. So let's do the math on that for a return. So 412.58 divided by 2951. Basically 13.9, 14% return. Again for 27 days. So that's one way you could do this. Now the downside of that is by doing this, basically you're selling two naked options. You're selling a naked put and you're selling a naked call. And anytime you sell an option that's naked, you have the potential for unlimited risk on both sides. So there you have no protection to the downside for this one or the upside on the call. So you basically have unlimited risk, even though it's not unlimited on the downside because it can't go beyond zero. It's still farther than you could ever survive in any typical account. So, but that's one way to do it if you want to do that. Now, another way to do this would be to sell an iron condor. And in this case, we have 1470, 1465. It knows what I want there. I'm going to have to adjust here to 1600. And 1605. Change it to 1. So what we have this way is that now we're selling the same strikes for the put and the call, but we're purchasing the next one below it on the put side and above it on the call side, which is our protection. So the max loss that we could have would be the difference between the two. this case, from 1600 to 1605 on the upside, and from 1470 down to 1465 on the put side. So that's our max loss. So you see we're collecting much less money in this case, only 50 cents. Before we were collecting quite a bit more. But look at the difference here. Now we collect $35.16 after commissions. We only tie up $156 because now, instead of that larger number before, because we had unlimited risk, now we have limited risk. So it knows that. So $156. So see how you can trade in a small account now? You only need to put up $156. But you should keep in mind, though, that the max loss could be the $450 that we have here if the market totally blew through one of your positions without you doing any kind of adjustments. But to get in the trade, to put it on, 156. So let's see what the return on that would be. And these are the trades we do every month, month in, month out. 35.16 divided by 156, 22.5%. And that's 22.5% for 27 days. So that would be the trade that I would do. And like I said, we do these trades. I do these trades every month. I do them on I have my basic ones that I like, and I stick with those. And each month I do them, and they work out almost perfect every month. I hardly have to do any work on them at all. Virtually almost none. I can't. Matter of fact, it's been many months since I've had to do anything except put them on and let them expire. So those are your go-to methods. Again, if they're trending up, you sell a naked put. If they're trending down, you could sell a naked call. And also at the same time, I didn't mention these earlier, but you can also, instead of selling naked puts and naked calls, if they're trending, you could also do verticals like I just did. So, and actually, let's go back and look at that right now. Let's look at the charts. And I think that was trending up. So just to give you an idea here, that's if it's trending up, then you want to sell a put. So we're going to sell 10 delta puts. Let's compare those two. Sell that naked. So we'd be collecting 346, tying up 1478 versus if we did a vertical, now you'd collect 3752 and only tie up 147. So see the difference? Much greater. And if we did the return on that one, 3752 divided by 147, again 25.5% for 23 days. So again, not a bad return at all. And of course, that's tying up 147. If you had, it's according to how much money you have in your account, you could put on 2 contracts, 3 contracts, 4 contracts, whatever you felt comfortable with. So those are all the methods used. You can of course go back and review this video over and over and over again and take notes if I went too fast for you. But this is it in a nutshell. Those are your strategies. Either sell a naked position, sell a vertical position, either calls or puts. And both of those are in the case of a trending futures contract commodity. Or if it's going sideways, you could sell either a strangle, to where you're selling a naked call and a naked put, or you could sell an iron condor, which is a naked, which is not naked, which is a put vertical and a call vertical together. So those are your major contracts, which I also reviewed those in the mini course. So that's it. That's the example. Hope this helped. And if you have more questions, feel free to submit them to us, and we'll do another video for you.
This concludes our 4-part mini course on futures and how to trade futures in large and small accounts. I hope this has given you some insight into how even with a small account you can still participate in the futures markets. You will just need to use technical analysis and find futures that are trending in an orderly manner and then decide the correct strategy to use. And even though by trading this way your profit is limited to the premium you collect, your capital required to place these trades is small enough to let you participate in the commodities movement. You just need to be patient and stick with these trades until you've built up enough free capital that you can move up and trade the contracts directly. But you may also decide that you like the relative safety of these trades and may just want to stick with these instead. And if you look at the power of compounding, you might be surprised to see what your gains could be after a year or more of trading these smaller, safer trades. So in closing, I just want to reinstate that you shouldn't be afraid to venture into the world of trading futures. I hope that I've shown you that if you have the capital, you can trade futures directly without a great amount of risk, and this is because you'll be using stop-loss orders to limit your risk and eliminate the chance of any large contract movement against you, which was your concern originally. Then if you want to start small and with less capital, then just use the strategies I outline in parts 3 and 4. Either way you decide to go, if you follow the rules, you'll be able to trade safely with limited risk. And one final note, aside from this mini course, which addressed your concerns for trading futures with less risk, there are quite a few things you could do to even better equip yourself to trade. For instance, you could learn more about either trend trading or technical analysis, and within technical analysis, you will have many different directions you can go. You could learn more about option trading, you could learn more about the different trading strategies beyond what we've covered here, and where I'm going with this is that I've produced a ton of content out there that is free for you to use. I have blogs that cover everything I mentioned above. I do a weekly radio show that also covers all of that. And of course, there are many other mini courses that will also explain all of these other pieces. But the more you can learn and compile into your knowledge base, then the better your trading will become. But just in case all of this still seems too large of a task for you to take on, I would suggest another option. Instead of taking all this on by yourself, you should consider coaching. Coaching is something that is used by every successful professional, at the same time something that is almost never thought about for the average person. But think about it for a second. Golfers have coaches. Boxers have coaches. Sports teams have coaches. Skiers have coaches. Actors have coaches. Even rock bands have coaches. And the list could go on and on. And one thing you may not know is that traders have coaches too. In fact, I can promise you that all successful professional traders have coaches. In fact, all large brokerage firms employ in-house coaches to support their in-house traders. And in fact, when I worked on Wall Street, I used our in-house coach all the time. So whatever path you decide to take, I just want to encourage you not to give up on your dream to become a trader. There is not another business in any field that has the potential to produce the kinds of gains possible as a trader. Remember, it's all about following the process, breaking it down into workable sections that you can tackle with ease. And remember, if you don't feel like going it alone, consider coaching. We want to thank you for watching. We hope you enjoyed it and hope that the information that you got can in some way help improve your trading. And if you'd like to watch the entire series for free, all you have to do is go to tradersacademy.org. That's tradersacademy.org. Fill out the form, give us your email address, and we'll send you a link to the entire series. Plus, we'll give you a free copy of our Reprogramming the Trader's Mindset book. And we'll give you access to a free 1/2 hour private coaching session. So if you'd like to take advantage of this offer, again, that's tradersacademy.org, tradersacademy.org, and thank you for watching.